two buyers bidding on the exact same $800,000 four-unit apartment building. The first buyer is a traditional real estate investor. Because the bank views this as a commercial enterprise, they demand a standard 25% down payment. That requires $200,000 in cash just to close the deal. The second buyer plans to live in one of the units. Because they intend to occupy the property, the bank asks for only 5% down. They secure the entire asset for just $40,000. That second buyer won the deal by utilizing a specific financing structure known as owner-occupied arbitrage. The United States government structures its lending guidelines to heavily incentivize primary home ownership. This deliberate policy choice allows everyday buyers to bypass standard commercial banking rules completely. This structural advantage expanded recently when Fannie Mae updated their guidelines. They announced they will now accept that low 5% down payment for owner-occupied properties with up to 4 units. For decades prior, buyers had to bring 15 to 25% to the table to purchase multifamily assets. That high capital requirement kept most middle-class earners entirely out of the market. Under updated programs like Home Ready, you can actually count projected rent from future roommates or an accessory dwelling unit as personal income on your mortgage application. You leverage the revenue of tenants you haven't even signed yet to help meet the income requirements for the building today. Government-backed FHA and VA loans will also finance multi-unit buildings for first-time buyers. But to mitigate the risk of these extremely low down payments, lenders impose severe mathematical barriers. If you use an FHA loan to buy a 3 or 4 unit property, you must pass what is called the self-sufficiency test. The formula takes the gross market rent from all units combined, including the one you plan to live in, and reduces it to 75% to account for vacancies. That reduced number must equal or exceed your total monthly mortgage payment, including taxes and insurance. If that projected rent falls short of the housing expense by even a single dollar, the entire loan is denied. The Department of Veterans Affairs takes a slightly different approach for multi-unit properties. The VA test dictates that the rent from only the non-owner-occupied units must cover the full mortgage payment, without factoring in your personal unit at all. Passing these tests proves that for these larger multi-unit properties, the bank prioritizes the income potential of the building as a primary condition for the loan. Beyond financial leverage, owner-occupants also gain a distinct legal advantage when selecting their tenants. Standard commercial landlords operate under the Fair Housing Act, which enforces strict anti-discrimination parameters on who they can rent to. However, federal law includes a specific carve-out known as the Mrs. Murphy exemption. It applies exclusively to property owners who live in a building with 4 or fewer units. Under this exemption, the owner is legally permitted to bypass certain federal housing discrimination laws when deciding who will rent the other units in their building. Sharing a roof with strangers creates intense psychological friction. The government recognizes this reality and intentionally grants owner-occupants legal controls that traditional investors are denied. Different operational setups generate vastly different returns across the house hack hierarchy. The classic duplex strategy, where you live in one half and rent the other, is historically popular. But with modern housing prices, that single rent check rarely covers a fully inflated mortgage payment. To achieve maximum cash flow, buyers turn to Tier 1 setups, which involve renting a single-family house out by the room. Some advance to Tier 0, the stack, which combines a basement apartment with co-living spaces upstairs. Once you maximize a property, you can execute the nomad strategy. You buy with 5% down, satisfy the mandatory 12-month occupancy period, move out, and repeat the cycle to build a real estate portfolio. To calculate your true return on investment across any of these setups, you have to account for rent avoidance. You are keeping the capital you would have otherwise spent paying rent to a landlord. Executing these high-density living arrangements requires strict operational rules to avoid logistical disaster. The first rule is ratio control. You should never exceed 3 bedrooms per full bathroom. Anything higher creates immediate friction and tenant turnover. The second rule is universal vetting. Corporate-level background and income screening must be applied to every single applicant, even if you are renting a room to a close friend. The third rule is maintaining a normal family exit strategy. You never want to modify a house so drastically that a traditional family wouldn't want to buy it from you later. This specific strategy functions as a targeted hedge against the single largest recurring cost in most household budgets. When rental income covers the mortgage, your housing expense essentially disappears. The property becomes a self-sustaining asset that no longer requires your active income to cover its own costs. Which tier of the hierarchy would you be willing to live in? Let us know in the comments.